What's up, everyone? So I wanted to go through the commercial real estate presentation. I just did a video, and I went through all these sections, I guess. So maybe I'll be more fluent now that I went through it once. I'm telling you, this is the best way to learn. Just make YouTube videos. Even if it sometimes it does take a little longer than like just if you were to read like 5 pages on a topic, could take what 10-15 minutes maybe. But if you had to make a video on those 5 pages, it could take like a few hours. But you do learn it a lot more making a video. But anyways, so I'm trying to learn more about commercial real estate. I guess the main reason was I just got hired as a controller at a real estate development company. So I guess that's the main reason. But it's part of investing. I mean, there's a lot of REITs. So this is pretty high level, although we do get into calculations later. And I'm going to get more into like the weeds as time goes on. But it seems like high level works. So commercial real estate is are properties that are leased to businesses, or it could be properties that have 5 or more residential units. So if you have like a little condominium development with 7 units, that's considered commercial real estate. But if you only have 2 or 3 units, it's not considered commercial real estate. Which is but if you buy a condo and rent it to somebody, that's the same concept. You're buying an investment and trying to generate income from it. But I guess the technical definition is it has to be 5 or more units. So it's pretty different, even though like commercial residential are pretty different, because you would think how do you value commercial real estate? Probably similar to residential, but it's not. It's very different, because when you buy a home to live in, say you buy a home for $300K. I mean, really the goal is, the hope is it goes up in value. So maybe in 7 years you sell it for $600K or whatever. The more it goes up, the better. Also, there's other positives, of course. You get to live somewhere without having to pay someone rent. You don't have to deal with someone raising your rent or possibly kicking you out if they want to sell the property. So there's a lot of benefits. There's you could depreciate the property. Well, actually, no, you can't depreciate it if you're residential, if you own it and you live in it. You could depreciate it if you rent it out, like an investment property. So really the purpose of commercial real estate is to make money, generate income. So the value of the property is tied to how much money it generates, how much income the property generates. Not so much the appraisal value. Like with if you were to buy a home, the value of the home is equal to what a similar home sold for in that same neighborhood. But commercial is different. It's about income generation, because you could have 2 buildings, right next door, like building A right next door to building B. And they could be identical buildings. Everything's the same. But building A has like $30K, say, a month of income from leases. People lease out the spaces. And building B could have $20,000 of income from leasing. And let's say they have the same expenses. They both put $10K a month each to maintain. So building A could sell for a lot more, even though they look identical. So it could be like, if you like, a lot of people who buy real estate, commercial real estate, they might not even do much work. Maybe, fix up a little bit, But if they could just find better tenants that will pay a higher rent, then you can sell it for a lot more money. So there are many types of commercial real estate. The common ones are office space. And leave a comment. Let me know. We could talk about other things too, but I did want to get through commercial real estate. So a lot of people probably worked in office spaces. I'm sure you visited hotels and resorts. That's commercial real estate. Retail. We all go to retail stores like Starbucks or Domino's. Those are in either shopping centers or standalone units. Another type of commercial real estate is multifamily. So you might have an apartment building with 30 units. Industrial, maybe Amazon needs a logistics warehouse. That's industrial. Or maybe there's a company that's looking to manufacture products. That's industrial. And then mixed use, so a combination. So sometimes you buy a building on in a city, like in a busy part of a city and the bottom part, the part where it has access to the street view, there's a business in there. Say it's a Domino's Pizza. And then the 2 units above the Domino's are rented out by people who live there. So that's multi-use. Neil, what's up? Thanks for joining. Yeah, I'm trying to, if you want to learn something well, just try to talk about it or teach people about it. Because I'm making a video, even though I'm not an expert on anything, I don't know. I'm not but we're all learning, but you'll learn so much faster. I guess I know it enough to do these videos, but I don't think I know. I think especially with commercial real estate, people know it a lot better than me. What kind of mortgages or interest rates? It's somewhat similar to residential. It's usually higher. The interest rates are higher than a residential. They're slightly higher, and obviously it's dependent on the credit history of the borrower, but probably more so is the tenants, how much income the property generates. But as I'm working, I actually did some consulting with property management companies, so I know that part of the business. Property management company is a company that just handles the tenants on a monthly basis. So if somebody builds a strip, like a little strip mall, say somebody, real estate developer pays $10 million for a strip mall, and then puts 7 or 8 units there, and then leases them out to somebody, the management company will handle all the day-to-day operations. So if the tenant, water's leaking, or the tenant is having, maybe an issue, there's homeless people in front, he doesn't want homeless people, it's hurting his business, he would call the management company. And of course, the tenant would send a check to the management company each month, and the management company will make sure that's the appropriate amount. Because when I was at the management company, there was never a month everybody sent in their check on time. The people were late. We have to charge late fees. Every year the rent goes up, so we have to make sure the tenant is paying the higher rent. And then some tenants, and in property management companies, it's usually a 4 or 5% fee. So whatever the say we collected $100,000, and we had a dozen buildings, but say one building we collected $100,000 of rent. Say there were 10 tenants, they all pay $10,000 each. So we collect $100,000 of rent payments, and the management company would just take $5,000 5% of whatever rent was collected. Sometimes it would be 4%, sometimes it would be 6%. And you obviously need a lot of units. You can't be a management company and have like 10 units. You have to like manage like 100 units or maybe 1,000 units. Really, the more the better, but it has to be a number high enough because the biggest expense with the management company is payroll. That's really the main expense. And anything that goes wrong with the building, if the building, if the roof caves in, you have to change the roof, or something happens with the electrical, the owner of the property is responsible for that. Oh yeah, Palantir. Hey Gary, property management companies are corporate HOAs. But property management companies are private businesses. The property management company I worked at, they also own the properties. So that's not always the case. Sometimes the owner of the property hires a third party, a third-party property management company to do the work. So usually when you buy commercial real estate, like there's different ways to do it. You can buy land and then erect a building. I mean, it could be just land that hasn't been used ever. It could be in a town that's just not as active as like New York City. Or it could be a town that's growing. But you buy the land, say that costs, $1 million. Then to construct a building, there's a lot of permitting, and there's a lot of not just obviously, building the building. But you have like different engineers, several different engineers to make sure what's beneath the ground, the soil, can hold the building. And if it can't, then they have to construct it in different ways or build out the foundation. But you have to get all these companies and all these in order to get your permits. So say you $1 million for land and then another $1 million for the building, so that you're already in the hole for $2 million. So you could just some companies just flip it. They construct the actual building and then they just flip it, hopefully for more than $2 million. So they sell for $3 million or $2.5 million. Some companies keep the properties and just make money by the lease payments. When a tenant pays each month, that's how they make money. Of course, it could take a long time to get your return if you just manage the property. It's kind of like flipping homes. If you say you buy a condo in your town and you're really good at fixing things up, you fix up the condo, you could rent out the condo. It's just going to take a longer time to get your money back, or you can sell it. But if you're using a lot of leverage, a lot of debt, then I guess it's okay to just buy a property, fix it up, and then rent it out, and just keep doing that. At some point, you might have a bunch of properties. So there's 4 classes of commercial real estate. Class A is the best. It's the nicest, the newest in construction. It's usually in a good location, and it costs the most money. And then Class B is one step down, a little older construction. It might have a common area, but maybe Class A has a security guard in front. Class B just has maybe a security system. And the rents are lower than Class A, but higher than Class B, average rent prices. And maybe it's in a town that's not as affluent or popular as Class A. Class C, lower rent than B, not much amenities. It's usually more bare bones. could be older construction. David, yeah, thanks for watching. Thanks for joining. Yeah, anybody leave a comment. I don't want to get too far off tangents because we can talk about anything for like an hour. And the location could be, not the best location. Obviously, not as good as A and B. Class D is usually a building that's just vacant, sitting there. It could be beat up. An old building probably needs to be taken down. No one's living there or working out of there. And then there's different leases you can offer your tenants. Single net lease, the tenant is responsible for their rent and the taxes. Double net lease, taxes and insurance and rent. I guess that's... Yeah, but I don't mind going off on tangents. Next week, I watched this guy. That movie Catch Me If You Can with Frank Abagnale, his life story. Leonardo DiCaprio played Frank Abagnale in Catch Me If You Can. Came out in 2002. It's about a con man who wrote bad checks, $2 million of bad checks. He impersonated a doctor, a lawyer, an airline pilot, and he was on a run from the FBI for many years. Then he got caught, but it was all a lie. He made it all up. And I'm going to have the journalist who uncovered all this stuff next week on a live stream. So I'm looking forward to that. So double net lease, the tenant pays rent, taxes, and insurance. I think triple net is really common. I always think of the name Tim. The tenant pays taxes, insurance, maintenance. So if you have a business and you want to lease a spot in a shopping center, the landlord may say that it's a triple net, which means you pay your rent, say $5K, and then $1K is a triple net portion. So it's kind of separated out. I mean, you would just, it's still $6K to you. It's not like it's no difference if he said $6,000 is your rent. It's the same thing as him saying $5,000 your rent, $1,000 triple net. It's still $6,000 to you, but it's a way the landlord separates it out. So each year they would look at how much taxes, insurance, and maintenance were for the whole building, then calculate it. I'll just show you. Like, that would be, so you would pay $12K throughout the year for triple net, for tax, insurance, and maintenance. And say the landlord calculated it was $100,000 for the whole building. How much the landlord paid for taxes, insurance, and maintenance for the whole building. And if your unit is 10% of the building, then you're responsible for $10,000 of the triple net, and you pay $12,000. So we actually give you $2,000 back. Or if it was $140,000, maybe taxes were more than expected, and things are going up, and he calculates your portion of triple net is $14,000, then you would have to pay $2,000, like a true up at the end of the year. And then going forward, he might charge you like $1,200 a month instead of $1,000 a month because expenses are getting higher. And this is more beneficial to the landlord because if things go up a lot, like insurance went up a lot in California because of the fire, or the, what's it called? Like there was like all the brush fires in California. So insurance went up a ton. So if the landlord just charge you $6,000 for rent with like a 3% increase each year, he would have to be stuck with paying the higher insurance. But with triple net, he's changing a triple net each year, depending on how much expenses were in the prior year. So your triple net may go from $1,000 to $1,500. So now you pay $6,500. If that makes sense. And gross lease, which means the landlord pays all the taxes, insurance, maintenance, and you're only responsible for rent. But you're still, in a sense, paying for the stuff. It's just all baked into your rent. It's just not separated out. So gross lease, landlord is responsible for all those additional expenses. You're just responsible for rent. So net operating income, which is a common term in commercial real estate, it's your gross income minus operating expenses. So net operating income is it's like EBITDA, actually, earnings before interest, taxes, depreciation, amortization. So it's pretty much your profit, but it doesn't include taxes and interest. So if you took a loan on the building, that's not part of NOI. Because if you think about it, if you wanted to buy a building, right? Like some people would pay all cash, some people would take a loan, but if you take a loan to buy a building, that loan is connected to you, not really if somebody else bought it. So that's why they always strip out the interest. So it's a common term, NOI. It's a good metric to figure out how healthy the property is. And I'll just show you an example. So say you bought there was a condo that you wanted to buy, 11 units. Let's just say a condo you were running, and this was your revenue. Well, let's pretend you don't own it. Let's pretend you're looking to buy it, and you're talking to the broker, and this is the information he gives you. You want to know the NOI, your profit, and he says, well, for last year, rental income of $100,000. That's the rent people paid to live there. Then there's a parking lot that, if you want a space, you have to pay a fee because there's not enough spaces to fit everybody. And that generated $25,000 of revenue. You actually might use that parking lot other times too, maybe to rent out spaces. And then you have a little laundry room where people put quarters in to use laundry. And that was $5,000 of revenue for the year. So revenue was $130,000 from the 11 units. And then you have expenses. You might pay a management company $5,000, which is like 5% of the revenue, or 5% of the rental income. Then taxes, $25,000. Repairs and maintenance. Usually the tenant is responsible for certain things, like the common area maintenance, or areas that everybody has access to is called common area maintenance, like the hallway. But you're responsible. The landlord is responsible for, like, if they need a new roof, the landlord has to pay for that. And then just regular maintenance on a property. So if that was $15,000 in expenses, and then insurance, $1,000. So total expenses for the whole building is $46,000. The NOI, net operating income, is 84. It's 130 revenue minus the operating expenses. So $84,000. That's how much you get if you buy the building. So obviously you want to know how much the building costs. And if he says it's 1.4 million, yeah, taxes right here. Do you mean income taxes? So when you calculate most things, when you calculate it, you don't do taxes because everybody has to pay a different tax rate. So NOI is before income taxes and interest on a mortgage. It's kind of like when you talk about how much money you make at your job. Nobody ever says after taxes. If you make $100,000 a year, you'd say 100, or 80,000, you make 80. Nobody says after taxes because everybody has a different tax rate and deductions, so it's not fair. So if the unit, the building costs 1.4 million, then you can calculate your cap rate. So cap rate is a really kind of common term for commercial real estate. It's kind of like the PE ratio. You know, the PE ratio, it helps you compare two different companies. Like, how can you compare Apple to like just another software company? Of course, Apple has more profit and revenue because they're huge. So you compare it like the PE is market cap over earnings. So that kind of makes everybody equal. So it's how much you earn based off of your market cap. Hey, Quags. Of course you get a return. I mean, you probably want a return higher than like 10% if you do these types of things, but so the cap rate, it measures your profitability relative to the costs because it takes into account NOI, and it's pretty much your ROI, return on investment. And the reason it's so helpful is because you can compare different properties. Because if you're going to buy, if one property costs $1 million and one property costs $10 million, you can't. And if both properties offered 100,000 of NOI, obviously you got to buy the $1 million property because you get $100,000, in your pocket, only investing $1 million. And this one, you got to invest $10 million to get $100,000. Even if this was $200,000, you would of course go with this one because it's a 10% return, and this return's terrible. To make them equal, apples to apples, this $10 million would have to give you $1 million of income for the year to make them equal. Then they're both 10%. Then in this case, it doesn't matter which one you choose, assuming you have enough money. So the cap rate is NOI over the value of the property. So he tells you it costs 1.4 million, NOI of 84,000. That's your profit after expenses. So the cap rate is 84K over 1.4 million, 6% cap rate. So usually the lower the cap rate, the less risk the investment is. Is the national debt something to be worried about? I'm not worried about it. It doesn't keep me up at night, but because the U.S. government has so much money, like they might have to raise taxes, the U.S. government, or print more money and keep inflation high. But it's a strong economy, the U.S. economy. But yeah, but it's hard. It's hard to me to really understand, like, is national debt, because it seems terrible. It seems like it's so high, we're going to be going into a Great Depression, but I don't think that's going to happen. We always have a lot of debt. We're always that's just who we are as a country. We consume a lot. We use a lot of debt. We consume a lot of products. It's not perfect, the economy, but it's much better than pretty much any other economy. So the cost of property 1.4 million, NOI 84K. So the cap rate is 6%. So let me just try to. So if there was another property where the cap rate was 9%, then of course, why would you not get the 9% property over the 6% property? Because you get a higher NOI for the same value. It seems it's kind of like so obvious. Why do you take this one? And I'm not saying you're wrong, but it's kind of like it's hard to kind of like think of ways to explain this so simplified. But I think it's kind of like saying, if you buy a stock today, say you buy Coke. And I don't know what they yielded. I'm sure it's not 6%. Say you buy Coke, which you feel pretty confident it's a stable company, it's not going anywhere, and they pay a 6% yield dividend. And then there's a company, there's like a midstream stock that pays 9%. So it's kind of like the same thing. Like why would anybody ever buy Coke? Why wouldn't they just buy the midstream stock, the riskier investment? Well, that's obvious. Now it makes sense, right? Why wouldn't they buy risky stock? Well, the stock could go down, but that's probably not going to happen in commercial real estate. It won't. The value of the property probably won't decline. But what's a huge risk when you invest in a high dividend? They just won't pay a big dividend. It looks great now, but next year it's down to like 2% because they can't afford the dividend payment. So if you buy a property and you're charging a lot higher rent than other properties are, because you got higher NOI, that it's not sustainable. So when you have a cap rate, a really high cap rate, it's usually not going to be sustainable. And the NOI is based on today, right? So the broker says in the past year, they had $84,000 of profit. But that doesn't mean what's a profit next year in 5 years? It's kind of like, what's the price of the stock next year in 5 years? That's what you want to know. And if you look into it deeper and you say it's a little strip mall with 5 slots, 5 businesses. And like 4 of the businesses pay, like, what was the 100? So it's 100,000 of rental income. So if this is the rent payment, one unit pays 5,000, one pays 5, one pays 5, and then one is I'm doing something new. I'm trying to get into commercial real estate since I just started a job at a real estate developer as a controller. So if you looked at the leases, this is obviously a little more in depth than what we're doing. But if these 4 people, like, everything looked good, they just signed a lease commitment, so they're under contract for the next 5 years. But this supermarket, who's a bulk of your rental income, maybe they're on the last year of the lease, or maybe they're struggling, or maybe whatever. So that's kind of would be a red flag, and you might not want to buy the property, or you realize that's why if it was a high cap rate, there could be risk that you won't be getting. So this is how I would think about it. Like, if you look at commercial real estate, and you might not buy commercial real estate for yourself, but if you're investing in commercial REITs, and you look at cap rates, the higher the cap rate isn't necessarily better. Sometimes a low dividend's better because it's always going to be paid every year, year after year. And those high dividends, they cut their dividend, the stock goes down 50%, so it wasn't even worth it. So I would think of it like that. There's much greater risk when you offer a higher cap rate. Ben Mala, I gotta check that out. So if the inverse, you could think of the inverse. If you knew, here's a good way to do it. If you were running this property for like a long time, and you had $84,000 of NOI, and you wanted to offer a 6% cap rate, then you would just take the NOI divided by the cap rate. So that's your sale price. Or if you think the cap rate should be 5%, it's $1.7 million. I don't think so. I don't think. Well, if it should, because if interest rates go higher, probably your expenses will be higher. So you'll end up raising rents. Well, let's just do the math, so it'd be easy to. So just to finish this out, So if you know your NOI and you want to sell it at a certain cap rate, you can do that. You can just take the NOI divided by the cap rate. Obviously, you want to do like a 2% cap rate so you can sell for $4 million, but no one's going to pay that. I guess cap rates, it's usually between, I think, 5 and 10%. It depends on a lot of things. It depends on the type of building and location, things like that. So the thing is, if interest rates go up, then things tend to get more expensive. So your like repairs and maintenance will go up. Insurance may go up a little bit. Taxes may go up. But you would usually pass that off onto your tenants. I mean, the thing is, NOI excludes interest. So if you had debt on the property, that's not part of the cap rate, but that does affect your cash flow. But I think it doesn't matter if rates go up or down. Generally, initially there's a shock and things change, but in the long term, in like 6 months to a year, you just adjust. Like when interest rates go up a lot, high rates, then supermarkets really get squeezed because they sell so many products. But they just raise their prices. So maybe in the first few quarters of higher interest rates, supermarkets are not doing as well, but then they adjust prices and they back to where they were. So they keep their 3% margin, whatever it is. The ones who really benefit from high interest rates are the companies like that sell really high-end products, like those really high-end jewelry stores. They seem to do really well. Williams-Sonoma, I remember when inflation got really high, it seemed like Williams-Sonoma was doing well. Those really premium brands were doing the best. But I don't think interest rates affect much. It just gets adjusted, whether up or down. Okay, cash on cash return. So this is more it's more for personal. You're like whoever bought it. This will be beneficial for them to look at. Not as much if you're buying it, although you want to know this, but it's not going to. This is not going to be part of your how much you pay for the property. So cash on cash return is your annual pre-tax cash flow over how much you invested. So it's another type of profit or return calculation. But I don't really use this too much. Maybe I will, but I don't have as much to say on this. IRR, which we'll do the whole calculation later on, which may be the most popular term. If cap rate isn't the most popular, it's IRR. This estimates the interest you'll earn on each dollar invested. It's the rate of growth that a property has the potential to generate. It goes beyond NOI and purchase price to estimate long-term yield, which it's just meaningless saying these things. We'll have to do a calculation where it makes sense. But what do you think, Victor? Do you think higher interest rates will affect? Because anytime there's a shock, like higher interest rates or inflation is higher, things change a lot in the short term. In the long term, everything gets adjusted. Like when fast food workers, when that requirement, fast food workers have to get $20 an hour now. So businesses like a McDonald's will really struggle, but then they raise their prices, and then that's how they adjust for it. because everything goes back to the consumer pays for it. How to add value to your, so that's really the goal, I guess. When you buy commercial real estate, you want to make more money. You want to somehow, I guess the best way, so you can flip the property, you buy it, fix it up, and then sell it. Or you can buy it, why take high risk and trouble if you can make a better return for less risk? But that's like, yeah, I totally agree. But that's like saying, like, just invest in like utility stocks. Why ever take a risk and invest in a Meta type stock, or Amazon, things like that? So the value of commercial real estate is not the value of the property. It's how much profit you generate, your NOI. It's not like buying a residential. Like, you could, if your neighbor really needed to sell their house and they were in desperation to sell because they needed to move, you might be able to buy it at a 20% discount if you have all cash. And then you could just turn around and sell it right away. And you know how much you could sell it for. You know how much it's worth. But with commercial, it's based on how much the tenants are paying. So if you have $100K in rent, you receive rental payments from your tenants, and then I buy it and just put a fresh coat of paint and then charge the tenants 50% more, it's more money. It's more valuable, the property now. And I have the same tenants as before. All I did was painted the place and charge higher rent. And it could have been the rent was low before, so the tenants aren't that upset. Of course they're upset, but they understand it because now the rents are in line with the market. Commercial loans can have a high rate. You want a higher cap rate to reward you for the risk. Yeah, commercial loans, it's definitely going to be a lot higher than residential. Sold during pandemic because. But I'll get more into like the financing, especially that's going to be part of my job. So so the goal is, when you buy a commercial real estate property, if you can if you just buy as is and raise the rent 30-40%, if they pay it, you increase the value of the property significantly. Like, let's do so revenue, expenses, and when you do the cap rate, you want to do the value as of today, not what you paid for it, because what you paid for it could have been like a long time ago. So if you're looking to sell it, maybe you want to do the cap rate what you paid for it for fun to see your personal return. But if you want to sell it, you have to. Okay. So it is, I mean, this is possible. You could say somebody owned a property and say you're owner B, you bought the property and you didn't even do anything. You just took it over and all you did was increase rent 20%. You didn't change anything. that totally, and then you make the property more valuable. Because if you were to sell a property using the same, of course the cap rate's higher, but that's because we didn't change the value. Now, if you wanted to sell the property because you bought it at a 7.5% cap rate, so let's just assume you can sell it also at a 7.5% cap rate. So now you could sell it for almost 1.3 million, and you bought it for 1 million. All you did was just raise rents. Would I expect appreciation rate of the real estate? Right now, I don't expect much appreciation. The appreciation of the real estate, but you buy residential, right? You don't buy commercial, or do you buy commercial? Because appreciation, there's some benefit, but the real benefit is how much money you make from the property, right? Not the value of it. Okay, so how do you improve your NOI so you can sell it for more, or maybe just charge higher rents? How do you do that? Well, you just, probably pretty obvious, but you just make the building look nicer. You maybe do new landscaping in front, new roof, solar. So you're probably more closer to appreciation than somebody who's buying like a strip mall or a standalone building with a commercial tenant in it. But yeah, but I suppose there's some appreciation benefit for any real estate, but obviously much more for residential. You could put a doorman in the building. That could boost the value. That, when people walk into a building, and if there's no doorman, they're probably gonna, versus an identical building with a doorman, if the doorman building was 20% higher, some people will pay it, or at least understand why. So that's how you could charge more, but also to add value to the property is cut expenses. Maybe you get a cheaper landscaper. You could maybe find cheaper alternatives, or maybe if the management company is not doing a good job, change management companies. And you're doing all this. Maybe you can, like the 1 and 2 at least, you're doing 1 and 2 to maybe raise rents, or you can bill tenants differently. Instead of charging them for rent, you can say you have to pay your utility bill also. We're not paying it anymore. And of course, decrease vacancies, do more marketing, there's brokers, some brokers are better than others. So in the example earlier, when we had so this was earlier when we bought the building at a 6% cap rate. But if we fix up the building a little bit, make the units look nicer, and we raise rents $100 per month, and we reduce operating expenses, maybe our brother does the landscaping, or maybe we find a cheaper person a cheaper what's it called, handyman. So $100 rent if it's 11 units. That means 100 times 11. That's each month, then times 12. So $13,200 in extra revenue just by raising $100 per month. And if you decrease expenses $250, that's $3,000 of decreased expenses. So now your income went from this is your income was 130. I guess your revenue was 130, expenses 46. So by increasing around $100 in each person each month, you went from 130 to 143 of income. If you lowered expenses 3,000, it went from 46 to 43. So now your NOI is 100,000, increased from 84,000. So if you wanted to resell the building at a 6% cap rate, now you could sell it for almost 1.7 million. We paid 1.4 million. And the reason we paid 1.4 is because NOI was 84,000. Now it's 100,000. But how do you? So let's see what they say about cap rate. It's the rate of return. The measure is computed by the cap rate simply represents a yield of a property over a 1-year time horizon, assuming the property is purchased with cash. So it's like the annual yield, same thing. So I just thought of that during this video. I thought of the dividend as a comparison. I didn't even read this. The capitalization rate indicates the property's intrinsic natural unlevered rate of return. So obviously, if you take on debt, that will change your return. So if you take on debt and you pay a 10% interest rate, you might be losing money. So several versions exist for the computation of the cap rate in the most popular formula, okay, NOI over market value. Okay, this is what talks about what I said earlier. Since cap rates are based on projected estimates of future income, they're subject to high variance. It becomes important to understand what constitutes a good cap rate for investment property. Okay, the rate also indicates the duration of time it will take to recover the invested amount. So a cap rate of 10% means it'll take 10 years. So a cap rate of 5% means it would take 20 years, because the 100 divided by 10% or 100 divided by whatever your cap rate is. So if your cap rate is 100%, that means your NOI equals the value of the property. So you would get your money back in 1 year. So net tax loss if you borrow. Well, it depends what your interest rate is. But it losing money on investment, as long as you do make money at some point in the future, because like losing money on an investment is not that bad. Like, let me give you an example. Say you if you paid $100,000 for a condo, right, and let's just say for the next 10 years, let's say you paid the bank, this might be a little high, but say for 10 years, you paid them $12,500 a year. for 10 years, which included interest. Because you have to pay principal and interest back on the loan. And let's just say the tenant, because the way you make money, like I'm going to assume it's a rental. Say the tenant paid you $1,000 a month, so that's $12,000 a year in rental income. So you lose $500 a year, which doesn't sound good, but after 10 years you own the property. So then it's all profit, and then you could sell it. What if it goes from $100,000 to $170,000? So you're already up $70,000. You have to obviously wait it out. But if you do this for like a dozen properties, you're gonna have a huge, a lot of equity on your hands. So yeah, so losing money isn't bad as long as you can sustain the losses and you do become profitable at some point. So there is a risk. So IRR, if you want to understand how to calculate internal rate of return, so you first have to calculate, because the definition of IRR is the NPV equal to 0. Did I write that down somewhere? Okay. IRR is a discount rate that makes the NPV equal to 0. So you have to understand the NPV to understand the IRR. I'm going to do the long way, and then I'll show you how to do it in Excel. So NPV, net present value. So the calculation is it's a future value divided by 1 plus the rate of return to the number of time periods. We'll just do years. That's the present value. So I'm going to assume there was an investment for $1,000. So you had to lay out $1,000 today. Let's just pretend it's a bond that pays an annual coupon. And you can multiply this by 1,000 and assume it's $1 million if you want to do it. But let's just pretend a $1,000 investment, and you get $400 back a year for the next 4 years. So how do you present value $400 a year from now? Or 2 years and 3 years or 4 years? So first we need a discount rate, which is like the WACC, weighted average cost of capital. So the discount rate is what you, as how you present value the money. And I'm going to use a higher discount rate, 20%. Usually it would be a lot lower. So we use a 20% discount rate. If you got $400 in 1 year, what's the present value of $400 in 1 year at a 20% discount rate? It's $333. It's 400 divided by 1.2 and raised to the first power, so you don't have to do anything. It's also 333 times 1.2. What do you think that's going to be? Of course, $400. So but that's only the first cash flow you received, year one. You also receive $400 in year 2, but what's that worth in today's dollars? It's 400 over 1.2 squared, or 400 over 1.44. So $400 in 2 years is equivalent to $278 today. In 3 years from now, $400, when you discount it back to today, 400 over 1.2 cubed is $231. And your fourth and final payment is $400 4 years from now. And the present value of that dollar amount is 400 over 1.2 to the fourth power, or 400 over 2.07, so 193. So what the hell does all this mean? So now you could calculate the net present value of this investment, because that's what you need to do pretty much with any investment, is to see how much it's worth in today's dollars and then decide, do I want to do it or not? So anyone else buying MPW tomorrow? Let's talk about MPW after this. That's a good one. I'm definitely not buying it. So to calculate this investment in today's dollars, it's negative 1,000 because you have to pay $1,000 for this bond. We called it. Then you receive $333, which is the same as receiving $400 a year from now, plus $278, plus $231, plus $193. So it equals $35. So the rule is, if you guys took any finance courses, the rule is project should always be accepted if the NPV is greater than 0. So it's only $35, not a lot of money, but that's the rule. The assumption is you have unlimited money, and no one has unlimited money. So if there was 2 projects, one was 35, one was 85, which one would you take? And don't say the 85 because you're wrong. Don't say the 35 either because you're wrong. But I don't want to explain why you're wrong with both. We can do that another time. But we'll stick to the general rule: is if the NPV is greater than 0, you accept the project. MPW. Maybe I should go all in, sell my house. I'll be right back in 1 minute. But does anybody know why I said, like, you have 2 projects, one with an NPV of 85, one with an NPV of 35, but no matter what you choose, it's going to be wrong, the answer. Do you know why I said that? But anyways, so you know how to do the NPV. It's the net present value. It's discounting future dollar amounts back to today's dollars. So now let's do the IRR. So the IRR is the discount rate that makes the NPV equal to 0. So this is the same exact thing as what I just showed you. It's identical. I just copied it. So the NPV is not 0, it's 35. So we need the IRR to get this number to 0. Since it's a positive NPV, that means our WACC, our discount rate, is too low. We have to raise it. So if we raise it 25%, now the NPV is negative. So we went too high. So let's go down to 24%. Still too high. 23%, 23%, still too high. 22%. That's pretty much it. We could lower it to 21.85, and there it is. I'm sure it's not exactly zero. I'm sure it's like 23 cents, but I don't care. I mean, even if it was 22%, it'd be fine. So the IRR for this project is 21.85%. That's a discount rate that makes the NPV equal to zero. But it's still like, what does that all mean? Like, how does that help? Let's hopefully maybe this next part will clarify. I mean, I understand what IRR and NPV are, but to explain it to somebody that doesn't understand it, like why, I'm going to try to do that. I have a hard time with certain topics, but I think, yeah, let's do MPW. Let's go through the slides. So the IRR, so if we want to get the NPV of this investment is shelling out $1,000 today and then getting a $400 annual coupon for the next 4 years. So how would we do that in Excel? You could do it really easily. You go equals NPV, and then you choose your discount rate. It's 20%. And then you have to choose the dollar amounts you want to discount back to today. So that's $1,035. That's what $400 for the next 4 years at a 20% discount rate is in today's dollars, $1,035. But we invested $1,000, so we have to also minus $1,000. That's our initial investment. So that's the NPV of the project, $35. So you would approve it because it's positive. But how do you calculate the IRR, internal rate of return? We want to find out what rate of return makes these cash flows equal to zero. So you do I equals IRR. You select all the dollars, all the numbers in parentheses, and 21.86%. That's your IRR. We could put 22. So if you only accept projects that have a higher IRR than the WACC. If the IRR is higher than the WACC, then NPV is always going to be positive. If the IRR is lower than the WACC, then NPV will always be negative. So it's not like they would never differ. They're always going to say either both true or both false. There would never be a situation where one is true, one is false. Is anybody following? Is this Oh, stink bid. I didn't see you join. Net margins look good right now, though there are other financial metrics. But isn't it really dependent on that one tenant? That tenant that's in default? Okay. What's the tenant's name again in default? Oh, Stewart. I always forget that. Stewart. How do I remember that? So how is this helpful? It's just numbers that realtors use or real estate developers use. So in this situation, if you were offered a project with these numbers, you pay $1,000. You can think of it as paying $1 million maybe, and then you get these returns for the next 4 years. And your internal WACC, that's your weighted average cost of capital. That's generally your hurdle rate. You want to be above that to make a good return. And if it's 22%, it's not really a great return. It's slightly better than what you borrow funds at. So you can accept it, but it's not like you're going to make that much money. But what if the project was $100 for the first 3 years and then $800 on year 4? Now we're talking. Now you get a 30% IRR, 228 NPV. So that's a good return. That makes sense. This looks like a good project to accept. But in finance, in textbook finance, as long as it's a positive NPV or the IRR is greater than the WACC, then you accept it. But this would be a much better project to accept than Godskin. What's up? Thanks for always saying thanks. I appreciate it. I'm glad. Does anybody? The capitalization rate confuses me a little bit too, because I think the analogy I gave you with a dividend yield makes more sense, because if a stock is paying a 10% dividend and another stock is paying a 3% dividend, why does anybody invest in the 3% dividend stock? It doesn't make sense. Just put all your money into 10% dividend stock. Well, because we all know that just because you pay a 10% dividend today doesn't mean you'll pay a 10% dividend tomorrow. Plus, the stock price could go down a lot, and then you could lose a lot of money. But with the cap rate, it's not as clear. I mean, I kind of understand it, but that there is greater risk that just because you have some tenants paying a lot of money today, maybe in a year from now, those tenants will not be paying rent. I don't know. But I need to understand this better, because maybe interpreting cap rate. Since cap rates are based on projected estimates of future income, they are subject to high variance. It becomes important to understand what constitutes a good cap rate for investment property. The rate also indicates duration. Okay, different cap rates among different properties. A different cap rate across different time horizons on the same property represent different levels of risk. There are no clear ranges for a good or bad cap rate. They largely depend on the context of the property and the market. If there's two properties that are similar in all attributes, except for being geographically apart, one is in a posh city center area while the other is in the outskirts of the city, all things being equal, the first property will generate a higher rental compared to the second one. But those will be partially offset by the higher cost of maintenance and taxes. The city center property will have a relatively low cap rate compared to the second one, owing to its significantly high market value. It indicates that a lower value cap rate corresponds to a better valuation and a better prospect of returns with a lower level of risk. A higher cap rate implies relatively lower prospects of return on property investment and hence higher risk. They also talk about the Gordon growth model, which I use in my videos. It's similar to the terminal value, the dividend discount model. And it says expected annual dividends over investors' required rate of return minus the dividend growth rate. This leads to the capitalization rate being equivalent to the difference between the required rate of return and expected growth. That is, the cap rate is simply the required rate of return minus the growth rate. Value of property. So it's you're assuming a certain growth rate but no one knows the future though. But if a community, if a town has limited growth potential, then you may be willing, versus another town that's maybe a town like Austin that's really growing and the future potential. Okay, I think that makes more sense to me. I don't know if it makes sense. So it's kind of like buying a stock at a 50 PE because the future growth is projected to be high. Paying buying a property with a high cap rate, like 10+%, is worth it because in the future, there should be a lot more money coming into the community, a lot more jobs and bigger businesses. Is less, so this cap rate is less reliable if a property has irregular or inconsistent cash flows. I guess it's the same thing with doing my DCF. If it's inconsistent, there's no single value that makes an ideal cap rate. Okay, good cap rate is 5 to 10%, while 4% indicates lower risk, but a longer timeline to recoup your investment. Okay, I think this is helpful for me, at least. Other features of the local market, such as competing properties, generally market properties in large, well-developed. So large, well-developed properties will have a lower cap rate due to competitive pressures from other businesses. Finally, the amount of capital you invest in a property can also affect cap rate. A renovation that makes a property more attractive could command higher rents, increasing the owner's operating income. Assuming that John has $1 million and he's considering investing in 2 properties, 2 options. One, he can invest in a government-issued treasury bonds that offers 3% annual interest, which is a safe investment, and the other is a commercial building. In the second case, assume that the total rent received is $90,000, and you okay. So this is a good example. So if this guy has $1 million and he could put it all into treasury bonds, which is 100% guaranteed, he get $30K a year in annual coupon payments, dividend payments. That's right. When I asked a question about like how much money is enough to retire, a lot of people said $1 million. But let's just pretend. Let's pretend the 3% is your. Let's pretend 3%, and let's say you need $50,000 after taxes to live. So 60,000 would do it for you. And because if you got even say you got a 3%, it's a guaranteed fixed payment for the rest of your life. So $60,000. The thing is, it's fine and good now, $60,000, but in 10 years or 20 years, you're still going to get $60,000. It's not going to grow because you're not putting it back into it. You're using it to live. So you need a lot more. That's why, like, having $1 million today, or $2 million, or $3 million, isn't going to do it. Because if you live off the dividends, eventually, unless you're like 80, but if you're like under 60, if you live off the dividends, eventually you're gonna have to start eating into the principal because the dividends won't be enough to live. Because could you imagine, like in 1980, you probably could live on like $30,000. And now in 2020, if you still lived from 80 to 2020 and you were retired, that's true. I know it is higher now because inflation. But if you want to use your example, then I'll do the 5% or 5.2%. So if you had $1 million today, because I was saying to my wife, we would need $100,000 a year after taxes to live. And we don't need that much, but I'm preparing for future years. And also there may be years like there was a year 2-3 years ago that I spent well over $100,000. Like I had to get a new car because my car was it was 21 years old. So I got a used car too. It cost $25,000. We got a new roof that was like almost $40,000. And then I have to live, even the bare bones living, the most basic living is still like $4,000 a month without doing anything. Just going to the supermarket, coming home, not going anywhere. So, so I spent well over $100,000 that year. But no matter what it is, it's never enough. Because once you get to these levels, once you have $1 million, you realize it's not enough. And once you have $2 million, it's not enough. Even when you get to 10 million, it's never going to be enough. It's always more you need. Which is unfortunate, but that's life. Okay, so let's go back to this example. They said 33%, right? Yeah, 3%. So that in the second case, so this is if he buys T-bonds or whatever they called it. And then the second example, assume that the total rent received per year is $90,000, and the investor needs to pay a total of $20,000 towards maintenance and taxes. This will help me remember it a lot more than just reading it. It leaves the net income from the property as $70,000, assuming that during the first year, the property value remains steady at the original $1 million. The cap rate will be computed as 7%, 70,000 over 1 million. This return of 7% generated from the property investment fares better than the standard rate of return of 3% from the risk-free treasury bonds. The extra 4% represents the return for the risk taken by the investor by investing in the property market against the okay. I guess that's clear. So if you got a cap rate of like 5-6%, it's not even beating inflation. I mean, it's not even beating the treasury bonds. But even if it's not beating it, it doesn't mean it's a bad investment because you're building, you're building a business kind of, because that property you can turn around and sell it for possibly more. In another case, if the current market value of the property diminishes to $800,000 with the rental income and costs remaining the same, the cap rate will increase to 8.75%. The surplus, which is theoretically available to property investors over and above, can be attributed to associated risks. Yeah, still didn't really super clear on what a good cap rate is, but okay. So MPW, Medical Properties Trust. So you guys are buying this. The RSI looks pretty good, 52. Usually like around the lower the better, below 40, but it's not too bad. I mean, it could be like it was 80 in March 2020. It did come down to 20s. But if you look at the RSI, and if you buy the stock when RSI is low, you usually do make money. But the thing is, it's about timing it. Like, you don't know when is a low point. It's like the stock price too. When's the bottom? When's the top? You have no idea. So if you what's a good point? Like, if you if it was $17 and you kept waiting, and then you got it at $7.50, thinking that was the bottom, and you were up like 30-40%, unless you sold it here, you're in the red, and you're probably not going to be positive for a while. But none of this really matters. It's just about the steward, right? It's about, will Stewart be able to pay? And they were going to sell the Stewart properties to United, right? United Healthcare. So that's the that's what everybody needs to know, because it's priced like, let's see the PE. It's below 7 PE, so it's priced extremely a huge discount. And that's just crazy. Remember when Meta was like 12, 13 PE? It was like, people plowed so much money into the stock and went up 5x. It's kind of like, you would never see like Amazon, Tesla trading sub 10 PE. Like, those stocks just will never get there. The future is always so. But they're losing money, so I guess that's a big issue. The thing, what I want to do is I want to try to buy options, which is probably everybody else is doing, before earnings, because you can't be going in the same direction as everybody else. So, although I'm sure there's so many people buying in both directions, the premium you would pay on the option would be so high. But I remember times when Meta was going down, like every time they did earnings in 2021, 2022, they were going down like 15%. So if I could have picked up options, well, let's figure it out. We can. When are they releasing medical property trust earnings? When are they releasing earnings? Is it this coming week? May 9th. So it's 6, 7, 8. So Thursday the 9th. So you can't. Okay, there you go. May 10th options, because you can't go too far out. Yeah, let's do May 10th options. It's at are you guys shorting it or longing it? I guess you're longing it because it's so beaten down the stock. You probably want to stay out of the money, pretty far out of the money. I'll show you how much options are worth. It never pays. Options just don't pay. It's so expensive. The the premium, the alpha, wait. The what Greek symbol am I thinking about? 487. So it's 487. So you have to go a little out of the money. You can't do 5. Let's do 7. Let's do 7. Do you guys know how to calculate options? So this is the current. We're projecting 7. Look, there's not much activity. It looks like the weekly from 1.7 to now, it looks like it's just making it a little lower, higher, heading back down. Okay, let's do 2 cent. There's just no volume. No one. Well, there's some open interest, but okay. Is that too much of a? Let's see. Maybe that's too much. So that's a 44% jump. That's too much, right? 44%. I guess let's just do 6. It's 23%. So let's do an option at 6. This one right here. Let's say we got it for 2 cents, which wouldn't be good, but we pay 2 cents for the option. Let's see, we got one contract. The cost per contract. This is like $2 per contract. I wanted to put options are expensive. I guess because it's May 10th. Oh, they expire on May 10th. What's the 17th? Okay, I guess you can't do May 10th because but it's May 9th. The let's just pretend it's a little more. Let's do the 4 cent one. So you have to only pay $4. for a one contract. It seems so cheap. I guess I'll stick with it. $2. So if you get $6 options, if the stock price goes to 7, new price. So that's your profit just for one contract, though. So if it goes to 7, you make $90. So if you bought 10 contracts, it's only $20. And if the price went up to 7, which is a big jump, I mean, it's not impossible, right? Okay, we'll do the 550. It's so cheap, right? It only has to go up 13%, and let's just say you paid the higher premium, it's 7 cents. 10 contracts. So maybe I'll just do a few contracts. It seems. So you can control 1,000 shares of MPW for $70, which is crazy, right? And then if it goes to $7, you get $800 in profit. If you buy 100 contracts, $700 is a lot of money. I wonder why. So if you bought 100 contracts, you drop $700 on it, which doesn't seem that much, right? Because I'm doing it right? And it went to $7. If it goes to $8, you get $24K. No one would put $7,000 on this. I guess that's so 100 contracts. If it's 487, if it doubled, you get $42K. You new also, right? Well, I own new. That's probably up a lot. 65 RSI. That went up the other day, I think, right? Yeah, it came back. It fell 1048. It came back up, but still, trading lower than 2 months ago. That was its high ever, I think. It must be. Yeah. It IPO'd at 12. And then I got really lucky. I got it at like 4.25. It went to 350. When did I buy it? I bought it June 2022. So I bought it at this bottom. It came up, but then it came back down. Yeah, that's now do puts for an iron condor. When's new bank earnings date? May 14th. So you can't do this one. You can go out to like 1350. There's much more put activity. Well, maybe not. There's a lot of in the money puts. Yeah, that's good. You averaged up. It's been doing really well. I'm sure it's paid off. Investor relations. How do you a press release? That's what I'm looking for. So February 2024. It's so old. News. Today's May 5th, so the newest one is April 26th. Oh, that's your biggest dollar gainer? No, that's my biggest percent gainer. Yeah, I'm up like 150%. 100. Yeah, that's my biggest percent gainer. Not dollar gainer, but percent. I can't wait to get to 40,000 subs so I can do a video on a portfolio reveal. It's been 2 years. I was at 30,000 2 years ago. Regular quarterly dividend. It sells majority interest in Utah hospitals. It's been a while since they talked about Steward. 220%. I did own Palantir. I sold it. Palantir. Wow, it's getting up there. I could have made a lot of money. Shouldn't have sold it. Oh yeah, it used to be really high. 35. I came pretty far down. $6. Yeah, it started at a 10. 6. Palantir. Okay, I guess that's thanks for watching the commercial real estate video and letting me get through it. I actually learned some more about cap rates. I think it's a little clearer in my mind what cap rates are. Let's all buy options tomorrow on MPW. You know, Palantir. Yeah. Okay. I'll see you. Try to join next Saturday for the Catch Me If You Can live stream. Okay. See ya.